clearly the big banks are going to get the annual stress test. There's no question about that. But it says in the law now they don't, the other banks are not subject to it annually. So what do you think is the right number? Is it every year, every other year, every 2-3 years? Do you guys have a sense?
I'd say when we think of highly rated banks and banks that really have good risk management and risk governance, stress testing is something that they do routinely. It's not something that they do just annually and not just because the regulators demand it and give them a scenario to follow. They're actually using it in their decision-making process. They're thinking through different scenarios, different things that might affect them more uniquely. So think about the energy downturn when oil prices were crashing a couple of years ago. The best banks, and you can probably look at this, the banks that did better through that downturn in energy were the ones that had a good setup, could look across their portfolios, could gauge what happens under different scenarios, and take more proactive action. So from the way I would think about it is, I think a big bank should be able to do stress tests on a routine basis, not just annually. If we take a step back, just to make it clear, we think regulation has been an important aspect in our rating analysis and has been supportive of the credit profiles of many of the banks. And so the things that loosen that, we would see as negative. And I think that's important. We think regulation has been supportive of bank fundamentals and improving banks and really making them more resilient, especially during times of stress. So, I think there's probably not much more on the legislative side. I think we'll see what happens on the regulatory front.
I think one of the things that's been coming out very clearly from this panel, as well as I think where regulation has been going, is there's this growing gulf between large banks and small banks. And so what's your take in terms of what that means and how should we be thinking about that going forward?
So I think even kind of going back to Dodd-Frank, there was what we termed tiered regulation, yes, even in there. So they were attempting to kind of make certain more stringent regulation apply to the biggest and largest banks. And so I think there's just a view that even if you look at the Senate bill that was just passed, it's really aimed at helping smaller banks. The point that we'll make is that there's really not much in there for the GSIB banks, and I think Julie, echoed that same point.
We've said that many times.
Yeah. I think we use the term de minimis, if anything, that comes out of that for the GSIB banks. But it's really aimed at trying to help smaller, and in particular the community banks. So if you look at the legislation, they even raised the threshold for the small bank holding companies, so from $1 billion to $3 billion. So again, it's just trying to ease the regulatory burden on that universe of banks.
But what about that group that's sort of, the large? We call them the large, right, regional. So let's talk about that a little bit, because they're getting, something pretty meaningful out of this.
For them, you're right, and I think for that group of banks, there is some meaningful impact from all of this. So there'll be much less stress testing requirements. CCAR likely gets eased up for that universe of banks. There's a lot of recalibration things that they'll benefit from. So clearly for that group of banks, they probably end up being a little bit of the winners from this. But it does mean different things to different banks. And I think that's been an important attribute all along in terms of how policymakers have been thinking about this.